You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, guys, I can tell you that I am super excited for a special show that we've put together for you today. If you've been listening in for the last couple of weeks, last couple of episodes, what have you, then you'll know that I've been dropping hints here and there and little bits of information related to an asset class that our team is really, really excited about, and that asset class is parking. More specifically, parking lots and parking garages strategically located in highly desirable CBDs, also known as central business districts, and also tourist locations where a high demand for parking exists, along with a decreasing supply of developable land. Really, in other words, a better way to put it is assets that are in premium markets that offer stable cash flowing covered land plays, as well as a potential for future redevelopment. Now, this is a sector that we were introduced to probably about 3 or 4 years ago, but we've been diligently studying behind the scenes now for about 2 years, and we've been anxiously awaiting the opportunity to release our findings to each and every one of you. In fact, last week, we just announced the book that Brian and I wrote on this sector, where we outlined the top 10 reasons why we love this space and how this investment vehicle generates cash flow and as well as legacy wealth. And you can grab a free copy of that by texting the word parking lot to 31996. Parking lot, all one word, to the number 31996. I'll also provide a link to the book in the show notes for this episode. Now, as you guys are aware as well, mobile home parks have been our space. And I will tell you that we're still super excited today about mobile home parks. But I can also say that we share a lot of the same feelings about parking and its underlying fundamentals from an investment perspective. In fact, parking shares many of the same quality attributes as mobile home parks, which is what we'll be discussing in detail today. And so with that, I've invited my business partner and principal of Sunrise Capital Investors, Brian Spear, to join me here today. I pulled him out of the shadows, and we're going to do this show together, which I'm very much looking forward to. So Brian, how you doing today, buddy?
Hey, life is good, Kev. How are you doing in this crazy time? I mean, how's life in your neck of the woods?
Just trying to enjoy every day, man. And it's a new world that we're in, but just trying to adapt to it. We're a resilient species, and we're making it through over here in the Bupp household. And that's it, man. How about you? You guys
same.
Maintaining the sanity?
To the best of our ability. We haven't been able to spend as much time in close contact with friends and family, right? So we've been hitting up as many Zoom chats as we possibly can. Yesterday was actually Easter Sunday, so we have this historical tradition in my family where we always get together and go to a hibachi grill on Easter, and we kind of celebrate the life of my grandfather. We'll have some plum wine. It's just kind of this long tradition that we've had for 20 years. We were unable to do it yesterday. However, we all got on Zoom. We did have our plum wine, and we did our best. Some folks got Chinese. Some folks got Thai. We couldn't do hibachi, but it was a really good experience. We just really enjoyed it. The kids loved it. So, you got to adapt. You're working through it.
Yeah, seriously, there's a lot of things to be grateful for. Can you imagine being in this exact same situation prior to, teleconferencing services such as Zoom being available to the general public, right? So like that type of functionality or service has been available for probably, 10, 15 years. But back then, most of it was like, enterprise type clients that would be using it for, big teleconference meetings, what have you. It wasn't really available for a inexpensive, price point to the general public. And so just very glad that that's there. Can you imagine not having that ability? I mean, you have a phone, but being able to see someone's face and share some special moments with them. So just it's the little things, man. It's the little things that we got to be grateful for.
Couldn't agree more. It makes life a heck of a lot easier. So,
yeah. So I gave some thought to this, Brian, of how we should conduct this show here today. And I thought that really the best way to do it is probably in a form of an interview, to where I'm just going to basically interview you, buddy. You're going to be like a normal guest on the podcast, and you're the master, the expert in the parking niche, right? You've been studying it again feverishly for many years now, and we've been behind the scenes really digging into the trenches on this asset class. And so I'm going to interview you, but I'm going to put you on the spot and try to extract all the good, the bad, and the ugly regarding parking, and again, why we're so excited about it. And so I think the best question to really kick this off with would be, simply put, why parking, man? Why this asset class?
Obviously, great question. A lot of ways we can go at this, but I think to begin, in order to convey why we love parking as an asset class, we have to explain what our goals are. What are we really trying to achieve, right? And our mission today is the same as it always has been, and it always will be. Our goal is to generate cash flow and build legacy wealth through commercial real estate investments. That's exactly what we do. We're trying to build cash flow for our families to create the lifestyle that we want to live. And for example, this past weekend, you had the ability, even in the midst of all this craziness, we were talking about it before we jumped on, to go out over the weekend, camp on an island, right? Jump on your boat, literally ride out to an island in the middle of the Gulf of Mexico and roll out a blanket and camp with your wife and kids. Bringing out some graham crackers, some schmallows, some marshmallows, and just grilling out. That's a unique attribute that you would not be able to do if you didn't have the cash flow to provide you with that comfort. But that cash is not enough, right? That's not the only piece of the puzzle. We also need the ability to build wealth over time. There are a lot of businesses that create cash. I'm thinking about flipping, wholesaling, a lot of these different real estate businesses that generate cash, but they don't create wealth over the long term. When we look back on what we've been able to accomplish, right, 40 years into the future, and we're looking back on what we've been able to do, we want to have accrued a portfolio of assets that will have allowed us to live the lifestyles that we would like, as well as when it's all said and done, we can pass that portfolio of assets on to our family members, right, building a legacy for the next generation. So that's what we do. That's why we do what we do. And that's why we've chosen mobile home parks. Historically, they've been the best performing asset class for literally decades. And we've done research on every respective asset class. You've been doing this for 20 years. Back in your 20s, you were in the single family residential space, owned 125 single family homes in your mid 20s, but ultimately pivoted to commercial real estate for the cash flow, right? You wanted to get into cash flow, bought some office, bought some retail, bought some mixed use, bought a litany of different types of commercial real estate, bought some multifamily. And as everybody on the podcast knows, everybody that's been listening to us for years, ultimately settled in mobile home parks for the reason that you and I know and love. Absolutely phenomenal long-term economics in the space, best performing asset class for many decades, and also the best risk-adjusted returns for as far as the eye can see. Green Street Advisors predicts that asset class is going to do better than any other real estate sector through 2024. So we still love it. But something has changed, right? In the last few years, businesses change, markets change over time. When we first started doing this, it was completely blue ocean. Nobody was really doing what we were doing. We were one of the first folks to come out in the podcast and talk about the merits of the asset class. But a lot of sharp money has come into the space in the last few years. Blackstone, Apollo Group, Carlyle, all these folks, these extremely sharp folks on Wall Street have rolled out billion-dollar funds and sought to roll up a lot of manufactured housing assets. And what that has done is it's compressed the cap rates in the industry. And that's fine. But what it's done is we now have to uncover more and more rocks to locate those diamonds in the rough. And that's fine. We love it. We're still uncovering great assets. But there are fewer of those assets today than there were 8-10 years ago, as the consolidation phase of the industry continues to grow. But how does that relate to parking? That brings us to parking, because parking today is very similar to what mobile home parks were a decade ago. Parking lots are a completely blue ocean strategy. For those of you who are unfamiliar what a blue ocean strategy is, it's based on a book that was written about 15 years ago by a couple of business school professors. And they basically conveyed that when you're going into any respective business and you're looking to compete in the marketplace, you can choose either a red ocean strategy or a blue ocean strategy. In a red ocean, there is a boatload of competition. Just envision a lot of sharks swimming around in the water where the market is saturated and they're all vying for the same respective product. Ultimately, what that's going to do is create some winners and some losers. And while somebody is going to ultimately get that fish, there's going to be a lot of blood in the water. And that's why they call it a red market strategy. It's a saturated market with a lot of different competitors. And over time, what that does is it lowers margins, and it's really truly a race to the bottom. Mm-hmm. Folks that are willing to continually buy assets at compressed cap rates and compressed margins, eventually the juice is no longer worth the squeeze, right?
Yeah.
So we have to continually seek out opportunities where we can partake in a blue ocean strategy. And a blue ocean strategy is where you're going into an environment where there are no competitors or very, very few competitors. And that's exactly what parking is. When you're not competing against a ton of rivals, you're not having to worry about those compressed margins and a shrinking profit pool. You're creating a brand new pool. And that's what we're doing when we're branching off into the parking industry. There are no institutional owners in this asset class yet, and we're looking to create a splash here as we progress. Kev, any thoughts here, buddy?
Yeah. I was going to say one of the most relatable asset classes as it pertains to the red ocean would be multifamily. I think everyone that's listening, even if you're not actively invested or even passively invested in multifamily, I'm sure that somewhere on your Facebook feed or Twitter feed or your LinkedIn, you've got a friend of a friend or immediate person in your circle that is in the multifamily space. It seems everyone and their brothers in the multifamily space, and that asset class has been consolidated. Everyone is really fighting for the exact same investment, and there are folks coming in by the droves on any given day that are new multifamily investors, and all the institutional capital has been in for quite some time, and the cap rates have been so compressed over time. The same thing, again, as you had mentioned, has kind of happened over the last couple of years to mobile home parks, not necessarily to the severity that has happened to multifamily, but it's there, it's present, and it's real, which again is one of the things that really excites us about parking, because it's very much blue ocean, lots of opportunity and lots of runway, we feel. And again, it's something we've been studying for quite some time. And as we've dug into this space, we've very quickly realized that there really, there aren't other folks in this space that have had the same mindset as us about consolidating this niche and running at it like we did ultimately 7 years ago in the mobile home park space. So yeah, with that being said, bud, let's go ahead and roll on here.
Yeah, couldn't agree more. I mean, it's an untapped market with a ton of potential, and once we realize that there is a potential here to really dive in and create that blue ocean, we wanted to dig into the merits of the asset class and view it from the lens of a real estate investor, and gauge if our investment thesis that we've had historically inside of manufactured housing can relate inside of the parking sector. And it truly does. I mean, I'll start with some of the very high level stuff. One of the very first things that we look for when we're vetting a given sector is favorable long-term supply and demand economics, right? When I'm buying any asset, I want to know that the demand for that product over the long term is going to increase at a rate higher than the new supply of that product that's coming online over time. If we can create that margin, we know that same store NOI growth is going to increase, creating, again, outsized returns and ultimately better compound interest over the long term. That's what we're really looking for. I can't tell you what's going to happen in 6 months. I can't tell you what's going to happen in 1 year, but I know that in 10 years or 15 years or 20 years, if we are in sectors that have favorable long-term economics, then we're going to outperform a lot of the other sectors out there. And when it comes to parking, we'll start with the supply curve. There are about 40,000 different parking lots throughout the country, but that supply is actually shrinking. Assets that are in short supply increase in value over time. And digging in through the census, from the years 2008 to 2017, the number of parking facilities throughout the country has actually decreased by 7%. And it's an amazing statistic. And it brings up the question, why? Why is that the case? And it's the same exact reason that we love mobile home parks: burdensome zoning regulations. When I look at different municipalities throughout the country, many of them have placed a moratorium on new parking supply. If you look at Cambridge, Massachusetts, Carmel, California, and many, many others, they've actually banned the new creation of brand new parking facilities in their downtown districts. And the question again is why? Why do they do that? Because they would prefer to have increased economic activity. Parking facilities are usually the least valuable zoning in any given MSA. they don't generate as much value to the local economy as nearly every other type of land use, every other type of zoning. What brings more value to the local economy, right? A 100-space parking lot or a 30-story high rise? I mean, a 30-story high rise is going to bring a boatload of jobs, a ton of folks downtown, and so much more economic activity. So city planners much prefer to avoid creating new supply in their downtown areas. In addition to that, the demand for parking is massive and continues to increase. Parking demand is a function of population growth and of transportation habits. And as everybody knows, the population has historically increased and is projected to increase precipitously over the next several decades. Furthermore, we've got about 275 million vehicles in the country today, and that's projected to increase significantly over time as well. So we know that the demand for our product is steady, and it's continuing to increase and will increase at a higher rate than the new supply coming online. And what that ultimately does is creates pricing power in the marketplace. Mm-hmm. The asset class has what is known as very inelastic demand. It is not perfectly inelastic, but it is very inelastic demand. I mean, when the price of gas jumps 15% or 20% or 30%, do people stop driving? No, they continue to drive because there's a relatively constant need for their vehicles. And in the same vein, the price of parking is relatively inelastic. If I need to go downtown because I'm going to go watch a sporting event, or I'm going to go downtown because I work downtown and I need to park there for my 9 to 5, am I going to stop going there because the price of parking went from $10 a day to $11 a day? No, that's a nominal increase of just a mere $1. However, it's a substantive increase in the bottom line NOI, right? I'm increasing the price 10% every time we do something like that. And it's the same exact unique pricing power that we see in the mobile home park space. When I have lot rents of $200 and I increase lot rents 10%, that's a substantive creation of value because you're adding a nice multiplier to that increase in NOI, depending upon, whatever the cap rate is for that real estate asset. But that's just the very first thing that we love about the niche is very, very favorable long-term supply and demand economics. Kev, you got anything to add on that, man?
No, I just want to reiterate a point. I mean, you mentioned, you spoke to the burdensome zoning regulations, which ultimately limits the supply of new parking facilities coming into any, respective CBD. But the exciting part, I just want to make sure we highlight this, is that use today as a parking lot. So if we're purchasing a surface parking lot in a downtown central business district, that is the least valuable zoning in that CBD. Like there is nothing that is of a less value than as its current status as a parking lot today. And so being that it's in a prime location, we're not going to be purchasing parking lots for the speculative play of a future redevelopment. However, we do know that they will cash flow. This will be a cash flowing covered land play in the interim, whether that be 5 years, 10 years, 15 years, what have you. And we know that our basis will never, ever be lower than what it is in that given day, and that there will always be a higher and better use sometime in the future. So that is exciting to me. It doesn't get better than that, Brian. I mean, when you talk about covered land plays, typically they don't make money. Normally it's a developer coming in, like they might help offset some of the expenses of a piece of property until they can get that development rolling. But when you talk about actually generating substantial returns and owning a prime piece of real estate in the CBD, knowing that there is also a future in higher, better use down the road, man, I don't know if anything gets more exciting than that. So anyway, I just want to make sure that we highlight that point there, and we can move on. I don't have anything else to add.
Love that. Yeah, I can't believe I breezed over that, right? Real estate is all about location, location, location. And the parcels of parking, either parking lots or parking garages, they're premium parcels. Just by the mere fact of having such demand that a human being is willing to pay just to be in that area, that the underlying land is extremely valuable. And if and when there is additional population growth to that respective MSA, and they need to create any sort of new development, be it office, be it retail, whatever the case may be, they're always going to call the parking lot operator first, because parking is the easiest type of parcel to redevelop. So love every bit of that. I can't believe I breezed over it. It's all about location, location, location. You can't get better parking parcels than parking lots, man. The next piece that we really love about parking is the fact that there's a boatload of mom and pop operators in the space. Manufactured housing is very, very fragmented, and the same thing exists in the parking industry. The majority of the assets in the parking industry are operated as single parking facilities, i.e. mom and pop folks own over half the assets, which creates an imperfect marketplace. We love the fragmented marketplace because, again, in an imperfect marketplace, what we can often do is buy with a nice margin of safety right at acquisition. And I oftentimes will go in a little bit deeper on why that's the case. But in short, in an imperfect market, there's less institutional capital, and therefore there are not a sufficient number of buyers, a large number of buyers on both sides of the transaction, buying for the buy and buying for the sale price. When you have a sufficient liquidity in a given market, the transaction price is often going to be right at that market price, whatever that market equilibrium is. However, in a fragmented marketplace, there are not a lot of buyers and sellers in the market, right? And in parking, there's not a ton of folks out there that are doing what we're doing. So that creates kind of a mispricing in an imperfect market. And because Kevin is so phenomenal at going and negotiating deals direct to owner, we're usually able to win that battle. When the price is not going to be a perfect market, when there's going to be a margin between what the buyer wants and what the seller wants, usually we can negotiate the price such that we're going in right at acquisition with a nice margin of safety where we believe the purchase price is beneath the true market value of that respective asset. Anything to add on the mom and pops?
Yeah, a couple of things here. So we're going to, number one, give you guys a case study towards the end of the show of a parking asset in North Carolina that we currently are in contract today, and we'll share with you some of the inefficiencies that exist based on its operations as it sits. It's owned by a local individual, so falls within that mom and pop classification. So we'll share that with you and kind of show you where the perceived upside is on those type of inefficiently run mom and pop parking lots. And so, just to give you an example, and I think a lot of folks that are listening can probably relate to this. Some of the inefficiencies that exist in the mobile home park space is just that. Mom and pop owned. The pop is running the day-to-day. He's doing the rent collection. He's doing the mowing. He's doing everything, and probably never went to business school, probably never really fully understood how to run a lean, profitable business. Over time, he's gotten tired. He's gotten a little lazy. He wants to spend more time with his wife. He hires people to do the work for him, doesn't do a great job of delegating, yada, yada, yada. Story goes on. But basically, you've got a business that becomes inefficiently operated. They haven't kept up with the market trends. Lot rents have not kept up with inflation, what have you. And we step into it and we treat it more like a business than a mom and pop. And we realize a lot of the opportunity, or uncover a lot of the opportunity that exists there. The same thing applies to the parking lot space. I'm sure that you guys have been to a downtown area. You've gone to park your car, and you try to find the credit card machine where you can actually pay for that space, and all you find is a big metal box with a couple slots in it that basically you're supposed to stick your $5 bill in and shove it into that space, and hopefully, you've paid, or if you haven't paid, your car doesn't get towed. They call those honor boxes in this space. And it's a very inefficient way to manage a parking facility. In addition to that, a lot of the parking lots that I'm sure you've seen as well has an individual sitting underneath an umbrella or collecting money, a parking lot attendant that's collecting cash. Very often that cash, 100% of it does not make it into the owner's hands or into the owner's bank accounts. There's a lot of theft and inefficiencies that exist there. And so just like there's inefficiencies in the mobile home park space because of the fragmentation, the mom and pop owners, that exists in the parking lot side as well, which again, are one of the many areas that excite us about this business. So that's all I got, Brian.
Yeah, love that. Moving on to the next piece that we love about it, it's the stable recurring income, right? We want to buy businesses that have very stable, very predictable recurring income streams over long periods of time. And parking is beautiful in that when we're buying assets, we have the opportunity to either operate these assets ourselves or bring aboard a third-party operator that becomes our tenant. And that is the latter is the option that we have decided to choose here. Basically, what we do is we buy the asset and we put out a request for bid to a litany of different parking lot operators in the space. Some are publicly traded companies, some are just national companies, some are regional companies, but all of them are high quality, credit-worthy tenants, and they vie for our business. They will sign either 5 or 10-year guaranteed leases. These are either double net or triple net leases, the typical stuff that you would see in a Walgreens or a Dollar General, things of that nature. But there's usually 3 different pieces to our respective leases that generate additional income, right? So you got the first section, which is just the annual base rent, the amount of money that we're going to be receiving in rent over the course of a year. The second piece of the lease is the annual CPI increases, right? This ensures that we can alleviate some of that inflation risk, if you will. So there's annual rent escalators. And then the third piece is revenue participation. And that is a beautiful piece. It's basically the icing on the cake that allows us to partake in the upside potential. We're usually able to receive about 50 to 80% of revenue above what is known as the percentage threshold. So basically, in short, all of the parking revenue that is generated, we will receive 100% of that revenue up until the annual base rent. Above that, the parking lot operator will receive 100% of the revenue up until the percentage threshold. And then above that, we will share the remaining revenue based on a percentage that we've negotiated in advance. From our perspective, this is the equivalent of having your cake and eating it too. It's basically like signing a 10-year lease with Walgreens that is guaranteed over that period of time, and it has annual rent escalations, and we are receiving a percentage of the Walgreens profits from selling retail goods. Typically in a double net or triple net lease, you're only going to get the annual rent as well as whatever the rent escalations are. We're actually able to partake in the operations of the renter, of the leasee as well, which is extremely appealing from our perspective. It's very stable, recurring income for literally a decade into the future. We know in advance we're going to make at least X amount of dollars over that period of time with the potential to make significantly more than that.
Yeah. And nothing else to add other than, and remember, there's a second cake potentially as well. So you got the first cake, which is profit sharing, but you've got that second potential cake that might come your way in 10, 15, 20 years, what have you, as a future redevelopment. We're not speculative investors by any means. We truly envision that to be icing on the cake, and we are not going into any deals underwriting that. But it's just exciting knowing that there's so many different opportunities in this parking niche, right? And again, it's such an untapped space, Brian. And I'll continue to say that we're super excited about it because we are. So moving on here.
Yeah, moving on. Another aspect that we really love is there's very, very minimal competition in the space. I already mentioned it, right? It's a completely blue ocean strategy. Literally nobody is doing what we're doing. When we first got involved in the mobile home park space a decade ago, there were some folks buying mobile home park assets, but nobody was leveraging the sector in the same way that we leverage a given sector, right? We take the experience that Kevin has garnered over 20 years, experience from the single family space, some of the most advanced marketing techniques that you see to go out and buy single family residential deals and wholesale deals, and we bring that to the commercial real estate sector. And when we first started doing that in the mobile home park space, nobody was going out and sending direct mail to the same degree we were. Nobody was doing direct mail and cold call campaigns to the same degree we were. And when we branch out and use our core competency in the parking space, there are zero folks in the country doing what we're doing. We've already seen the merit of it. We've already sent out direct mail campaigns. We've already received feedback. The deals we have under contract are generated from those direct mail efforts. And we know that we're creating a new market.
Yeah. So as Brian had mentioned, one of the core competencies that really helped me build my business many, many years back in the single family space, and ultimately what we brought over to the mobile home park space, which we're ultimately going to take into the parking lot space, is the direct to owner strategy, dealing direct with these owners of these properties, the mom and pops of these properties, utilizing direct mail. We've sent out hundreds of thousands of direct mail pieces, as well as cold calling. And so we have a very systematic approach that we take, and we're ultimately going to do the same thing here in the parking lot space. And one of the big advantages that we had in the mobile home park space, which, it's still an advantage today, but, again, there's more and more people there. We've taught a lot of people exactly, how to generate leads by utilization of our strategy, going direct to owners. Back 7, 8, 9 years ago when we got into that space, you couldn't just go buy a list of every mobile home park that existed in the U.S. It didn't exist. Many different reasons for that. We don't need to go into that now, but you couldn't just go buy the list and ultimately start contacting owners directly. And so we essentially built out a team of virtual assistants in the Philippines and a few other countries to essentially do that on our behalf. And it's taken many, many years for us to develop that list. We've been doing the same thing in the parking lot space. Today, you cannot go out and essentially buy a list of every parking lot and parking garage in the United States. It doesn't exist. And so again, that's going to be one of the advantages that we have. We've already been off and running behind the scenes, building out that database, focusing on a few specific markets, and ultimately we'll continue to build that database out and take that direct to owner approach. So again, it's one of the big benefits that got us ahead of the curve in mobile home parks, and ultimately we feel it's going to be one of those benefits that gets us ahead of the curve in the parking lot sector as well.
Agreed. Heading on to the next piece we really love about this asset class is that it has very, very modest maintenance requirements. So there's very, very low maintenance in the niche. It's one of these asset classes where you don't have to worry about toilets, trash, or termites. There's really not a lot of moving parts in a parking lot, right? You've got asphalt, you've got the parking lines, you've got the bumper blocks, but there's really not a ton there in terms of the ongoing capital expenditures that you're ultimately going to have to dump back into a business. And that is a beautiful thing over the long term. The longer you hold that asset, the more beneficial it becomes because it's going to continue to throw off cash. For those of you who are familiar with Warren Buffett's philosophy, one of his favorite businesses is See's Candies. Parking lots are very similar to that because there are very minimal ongoing capital expenditures that you're going to have to dump back into the business. So there's really nice margins, which creates high quality cash flow today, and the ability to take those retained earnings and either pay them back to our partners or go out and buy additional assets with the cash flow that's generated over time. So it's a beautiful thing. Anything that you'd like to add on the low maintenance requirements here?
Yeah, no, and I like to pair the low maintenance with the benefit of the the double or triple net lease. One of the challenges that that folks face when they get into the investment space is that they start buying single family rentals, they buy multifamily properties, they buy mobile home parks. The list goes on, is the operational side of the business, right? Not just the operational of collecting rents, what have you, but also dealing with the toilets, trash, and termites, especially if you're talking about residential type of real estate. And that creates a little bit of a barrier from a scaling standpoint, right? I mean, you can only run so fast. If you're dealing with the toilets, trash, and termites all the time, it limits your growth potential. And so looking at the opportunities here, being that very low maintenance, and also the ability to get a national or regional or even one of the publicly traded companies that are in the operational side of the space, get them in there, do what they do best, we can run a lot faster, which again is a very exciting part of this asset class for us.
I agree. The third-party operators in the space are extremely high-quality folks. They provide you with a comprehensive turnkey package. They supervise the facility. They collect and deposit all the respective revenue. They'll restripe the facility as needed. They do all the typical small daily maintenance items, and they maintain the parking equipment. I can go on and on. That allows us to focus on what we do well. Our core competency has been, always will be, to go out and buy deals off market direct to owner. 85% of the deals we've ever acquired have been done in that manner. And it allows us to focus on our core competency and bring aboard somebody that is a really, really high quality tenant for many, many years to take care of some of those operations pieces, again, so that we can focus on what we're really, really good at. Moving on to the next piece, one of the things that a lot of investors really love real estate for are the tax benefits. In the same vein of mobile home parks, parking assets are remarkably tax efficient. Much of the purchase price can be allocated to the shorter-lived capital improvements, i.e. asphalt and underground utilities, et cetera. These have a 15-year depreciation schedule as opposed to the typical 27.5-year for residential real estate or the 39-year time horizon for commercial real estate. In addition, there's obviously been some benefits here over the last few years in regards to favorable bonus depreciation. So a good percentage of the purchase price can be depreciated in year one should you choose to do so. Again, really, really remarkable tax benefits in this industry. Any additional thoughts, Kev?
Nothing, man. You covered it well.
And I feel like we're burying the lead here. One of the main reasons we love parking is the recession-resistant nature of the asset class. That is one of the main merits of the sector. Obviously, when we're vetting a given asset class, protecting the downside is always top of mind. All asset classes are going to do well during a bull run. I mean, I don't care if you're buying stocks. I don't care if you're buying bonds. I don't care what type of real estate you're buying. When the market is increasing, a rising tide lifts all boats, and you're going to do well during those bull markets. The true test of the asset class is how does that asset perform during a bear market when the recession hits. And manufactured housing historically has done exceptionally well. Parking is doing exceptionally well in the same vein. The demand for parking facilities is often spread amongst numerous different sectors of the economy, as opposed to having one share pulled out from you, if you will. If you're reliant upon one different sector or one different income stream, that's not the case in parking. You're getting demand generators in the downtown CBD from multiple different businesses, from sporting venues, municipal buildings, offices, restaurants, and entertainment that are often downtown that drive folks to your one individual parking facility. And for that reason, you're very, very recession resistant. From 2007 to 2009, commercial real estate prices dipped, sometimes precipitously, depending upon where you were. However, revenue in the parking industry increased 3.6%. So it's done quite well during periods of recession, and we foresee that continuing as we progress. Again, protecting the downside risk is one of the first things that we look at in a given investment, and parking comes through in spades in this regard.
Well, awesome, Brian. I mean, again, just really comparing it to mobile home parks, we wanted to make the comparison because, as you guys know, we've been in that space for many, many years. And a lot of the attributes that Brian just shared with you are the same exact reasons why we were attracted to the mobile home park space, many years back, and continue to be attracted to that niche here moving forward. And so, Brian, I'd love to chat about, markets, right? And we talk about location, but what type of markets offer the best opportunity? Generally speaking, offer the best opportunity for parking investments. I'm sure that's something that the listeners are probably thinking about. Like, okay, parking's everywhere, but like more specifically, what are we looking for, and what do we feel offers the best, opportunity for investment?
Love the question. My initial reaction is going to be kind of our philosophy, just generally speaking. And that is kind of mimicking Sam Zell's philosophy on markets. We don't buy markets, we buy deals. Sam Zell was asked on an interview on Bloomberg several years back. He's often asked, right, what markets are you in? What are you looking for? What markets would you like to invest in? And his response was crystal clear, very simple, but very, very powerful. We don't buy markets, we buy deals. So we're the same way, right? The underlying microeconomic fundamentals of a given marketplace, right? We already know the 10,000 foot view. The parking sector is phenomenal. Macroeconomics are beautiful. The microeconomics of the MSA have to be solid, right? The underlying demographics, the jobs in the immediate vicinity have to be sound. However, that's not enough. We need a good deal. And whether or not we're going to buy an asset is often dependent upon the risk environment in today's current economy and whether or not the purchase price of that respective deal would justify taking that asset to closing. So I hesitate when folks say, where should we focus in terms of markets? We don't focus on markets, we buy deals. That's where we start. And then we need to ensure that both the macroeconomics and the microeconomics make sense. But that's always my response when I hear that question. Kev, you can dive in a little bit deeper on markets, but if you'd like.
Yeah, no, and again, we're going to share that case study, and we'll talk a little bit about that market, but I don't want to get there now. I'm going to save that for the end. And so we'll give you the details in the market that deal is located in, and that's it. We went after a deal. We didn't go after a market on that particular. It's in a phenomenal market, so don't get me wrong. It's not like in the middle of rural Oklahoma. It's in a phenomenal downtown CBD, but we went after the deal. And so again, we're going to share. Brian, I'd like to just wait a few minutes, and we'll cover that here towards the end of the show. What I'd love to chat about is more on the risk side of things. I mean, we've talked about all the benefits, right? All the best quality attributes of parking. But as we know, there's inherent risk with any type of real estate investing. It doesn't matter what asset class you're in or what investment vehicle you choose, there's risk associated with it. And so what do you perceive to be some of the biggest risks? Or if there's the one big one that sticks out like a thorn, what is that one big risk that could potentially wreak havoc in the parking lot space?
Yeah, great question. I'll never forget it. When we were first vetting the asset class and kind of wanted to dig a little bit deeper into the space, I went to some of the national conferences, and I'll never forget going to my first national conference in parking. afterwards, I was so unbelievably excited. I jumped on the plane, and I remember feverishly opening up my MacBook and typing as quickly as I can, providing a SWOT analysis on obviously the strengths, weaknesses, opportunities, and threats in the respective space, and why it's an unbelievably compelling space. But you're correct. No asset is perfect, period, end of story. And parking certainly isn't perfect. There is a respective threat that is not a matter of if, but a matter of when. The number one risk associated with buying parking facilities comes down to automation, AI, autonomous vehicles, and self-driving cars. Mm-hmm. That is an inevitability. It is not a matter of if, it is a matter of when. When you go to the national conferences, it's kind of the chatter, right? It's kind of the chatter. And you've got two schools of thought. You've got some of the older school guys that feel that this is not going to occur for many, 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 many decades, if at all. Then you have some of the more high-flying tech guys that are pushing newer applications and things of this nature for AV that believe that this is going to be adopted much, much sooner. So again, over the last year and a half, we've dug deep and tried to uncover as much information as possible. And just to provide a little bit of a primer, automated vehicles are rated on a scale of L0 to L5, where L0 has level 0, no technology, and level 5, L5 is autonomous vehicles that can drive around where you can sit in the back seat and do whatever you'd like. In order to get to L5, which would really significantly disrupt the parking industry, there has to be just an enormous amount of infrastructure replacement done throughout the country, right? A self-driving vehicle can't drive on its own unless the underground infrastructure not only can speak to the car, but also has been rebuilt such that the lanes are very crystal clear and a million other things. Ultimately, what the data says is there's no material change from 2020 to 2030 in the demand for parking. After 2030, you'll start to see somewhat of an impact there. But even in the worst case scenario, right, where there is a high adoption of autonomous vehicles, we would not begin to see significant disruption in the industry for about 30 years, 25 to 30 years, which is more than enough runway to buy assets today while parking demand is still sufficient to justify acquiring that asset today and allow the underlying land value to increase over time. To your point of having a really nice safety net on the back end, even if there is a very high adoption of autonomous vehicles 20, 30, 40 years down the road, and the demand for parking diminishes, we will still have a very, very high quality parcel of land in a downtown urban CBD or in a high tourist demand area. And that is a beautiful safety net for us. That is the parcel that will ultimately likely be redeveloped into a higher and better use at that time. So any thoughts there, Kev?
Yeah, and I think the autonomous vehicles part of that argument gets taken out of context a little bit, because if you really think about it logically, if I traded in my truck and had a fully self-driving vehicle where I was commuting to my office in downtown, I still have a vehicle that needs to park somewhere, Brian. Just because I'm sitting in the back seat working on my laptop on the way in doesn't mean that car doesn't need to be staged somewhere. It doesn't need to park until I'm done with my workday and want to come back to suburbia. Correct? I feel like that part of the argument's often missed. And so that it doesn't necessarily mean that there's going to be less vehicles on the road. It just means that technology is going to advance in such a way that these vehicles will allow the ability for them to drive themselves, and their, the commuter, the person that's inside that vehicle, not the driver anymore. I don't know what you call him. He's a passenger now, even if he's, the only person in that vehicle, allows them the flexibility to do other things during that commute. I'd love your thoughts on that, but I feel like that gets missed quite often when people talk about AI and vehicles.
There are different schools of thought on how this will ultimately play out. Some folks say just that, right? That when the passenger is dropped off at their respective location, the vehicle will go park in an off-street parking garage in the immediate vicinity or relatively close by. Some other schools of thought convey that vehicle might drive itself back home. That vehicle might drive itself back home, and then at the end of the day, when it's supposed to, when that passenger needs to get picked up, it'll come back out. Should that be the case, we have a beautiful safety net there, such that the land values have increased over 30 years, such that we'll likely have a nice redevelopment play at that time. Furthermore, if we're talking about a parking garage, there's a lot of new redesign elements that have been put out by a lot of consultants in the industry as to how they're going to repurpose the existing parking lots and or parking garages, whereby instead of having maybe 4 stories in a parking garage, they might have only 3 stories in a parking garage and green space on top where they might grow something, or 2 stories of parking whereby they might have green space up top and then retail on the bottom, or whatever the case may be. There's a litany of ideas going around, and nobody truly knows what's going to happen 40 years down the road. But the mere fact that we've got a beautiful safety net, knowing that we own the land, we own the asset in and of itself, and that over 30 years, with the beautiful margins that we've created, we know that we'll have a nice safety net if and when that parcel has passed its useful life expectancy and is no longer the highest and best use as a parking facility. There will most assuredly be a higher and better opportunity available for that parcel of land.
Yeah. Correct. And, given the unprecedented times that we find ourselves in, Brian, this is something that we surely wouldn't have brought up as a topic or potential risk 3 or 4 months ago. But again, we're here today, and we're dealing with the COVID-19 coronavirus pandemic that is sweeping the world. So let's talk about that as far as an associated risk with parking. Obviously, people aren't leaving their houses today. They're not traveling to sporting events. I mean, the world's essentially shut down. So parking, as with many other asset classes, are feeling the pain. So what are your thoughts on that?
Yeah, I mean, we're still working through it right now. Nobody knows exactly how it's going to play out. The parking demand has come down, but you got to remember, when we're going out and signing these 5 and 10-year guaranteed leases with creditworthy clients, that lease isn't on an annual basis, right? So they need to provide us rent over the course of the year. And there's different schools of thought on how that's going to be handled out, right? They just don't know yet. If some of the operators are going to enact what is known as force majeure to convey that it's basically an act of God to come in, something that's an unforeseen business circumstance, which mitigates their need to actually pay that annual lease. We don't know yet. But that said, these pandemics, right? I mean, it was a completely black swan event, and there's really very few industries in general that have not been impacted by the pandemic. It is what it is, and it's a once in a century sort of event, and again, completely black swan. We would hope that we don't see a litany of these during the ownership of the asset over the next 30, 40, 50 years. But that's just my high level thoughts, Kev. What do you think?
Yeah, no, I think you're right. Anyone listening to, more than likely, everyone listening to this is the first time you've ever experienced such a thing, right? You can look back, you look at the SARS and the Zika virus, all these other, not pandemics, I guess epidemics. I don't know what they're classified as, but all these different events in time, but none of them, created such havoc as what we're experiencing here today. And so this is a first for practically everyone that's listening in right now. And so, Brian, just like everyone that's listening in, just like you and I, we're dealing with it on a day-to-day basis, right? There will be a new norm that we get back to. It won't be the past norm. Things will surely change, and we're just looking to adapt as time goes on. But sooner or later, people will start commuting again. People will get back to going out to eat, to dinner, to shop, what have you, to waterfront districts and downtown areas. People will go back to their office buildings. Life will get back to some type of normal. Again, when that happens or how that transitions out, we don't know. And so at this point, it's pretty much all conjecture. But we do know that it will happen at some point in time. That's all I can say. I don't really have any other input to give other than that.
I would leave with this, right? I agree. Nobody knows what's going to happen over the next 2 months or 3 months or 6 months or even a year. But when we buy an asset, we take the philosophy that we are willing to hold that asset for at least 10 years as needed to ride out a recession if needed, right? We want to buy assets that have cash flow in place day one because we don't know when that next recession is going to occur. That said, we know that in 10 years, the value of this parcel is going to be higher than it is today. So long as we go in and we buy in markets that have sound underlying fundamentals, and we buy good deals, right? And we actually take down deals that have high quality same store NOI growth. I can't tell you what's going to happen in 3 months, but I can tell you in a decade or 2 decades or 3 decades that we're going to be sitting in a pretty good position.
Yes. Well, Brian, is there anything else that we might have missed on? I'd love to share the case study that I've been kind of promising, the entire time here, but I want to make sure, is there anything else that you might feel is relevant to the listeners regarding parking and, parking as an investment vehicle, what have you, that we need to hit on before we roll into this case study and then ultimately wrap up the show?
I don't think so, right? I mean, we could be here probably for hours, but let's keep it moving. We're going to put out more and more information on this. We just wanted to provide a little bit of an overview of the niche and why we love it so much. So let's roll through the case study and just keep it moving.
Yeah, and I'll just share with you guys a really high-level perspective. This type of opportunity, I don't want to say that it's an anomaly because I don't think it is. I think there's many opportunities that exist just like this one. And so, very simply put, this is a small parking lot we're currently in contract with today as we record this. It's in downtown Wilmington, North Carolina, which is an absolutely hot market. It's right on Restaurant Row. It's on a signalized hard corner. It's a surface parking lot, approximately 25 parking spaces there. It's owned by a doctor. He's owned it for 10 years. And originally, this doctor was essentially running it himself. He had his son collecting, rents. I don't know how that went. Their financials are kind of messy years back. I know that he wasn't making a lot of money. A local operator came along and essentially offered him about $2,400 or $2,500 a month to essentially, lease the space from him and take over the parking operations. He did accept that offer. Today, that local operator is still running that parking lot. The owner of that parking lot, he's been trying to sell it as a development play. I mean, it's a signalized corner right in the heart of downtown. It's already got 80 feet of vertical air rights, and so there's some architectural work that had already been done to where it could be redeveloped with first floor retail and multifamily above it, going up 80 feet, so 8 stories. And obviously that never took place. However, he's been ultimately marketing it as a redevelopment play. The underlying cash flow on it isn't all that substantial. Again, he's making about $2,500 a month. As we dug into it a little deeper, we spoke with another operator in that marketplace. That operator knows the marketplace really well. We did not share with him any details on what we, were considering paying for the property. But what we wanted to find out is, if we purchase the property, what he would offer as far as an LOI, a contractual agreement on a long-term 5 or 10-year lease, given the market and the local economics, and again, his experience in that market as far as managing parking operations are concerned. And very quickly, after just doing a little bit of research, he essentially was willing to sign a letter of intent or LOI at $70,000 annually. With that being said, we have this parking lot under contract for $695,000. That $70,000 annually has also 2.5% rent escalators in it on an annual basis. And you guys can do the math. I don't have to do it for you. You can simply do the math there based on what we're paying for it, based on what he's going to pay us on a annualized lease over a 10-year span of time. And you'll see that there's a lot of opportunity there for us to have a very profitable cash flowing covered land play in a phenomenal downtown area. It's a surface lot, as I'd mentioned, and so there's very little maintenance and upkeep. It's got a gate around it already. It's got some automation already in place, and really it's just a matter of sealing the asphalt. When that time comes, today it's in great shape. The taxes are very low on it, and the general liability policy is incredibly low as well. And that's really the only type of expenses that are associated with this particular surface lot. Brian, I don't know if you'd like to add anything else to it, but that type of opportunity exists in many other markets in this country. That is by no means an anomaly. It's a great deal. Don't get me wrong. We're really good at finding great deals. So that's why I wanted to share that. It is almost a 10 cap going into it with the type of arrangement that you might find in a Walgreens or a CVS, right? And so, Brian, go ahead. And I know you probably got some thoughts as well.
Yeah, I mean, the ability to go in and buy a double or triple net lease guaranteed over an extended period of time at an unlevered temp cap is something that you're not going to really find in a lot of other asset classes. And it's not an anomaly, right? We'll continue to find additional assets that are similar to this. But I think a lot of that has to do with the fact that parking has historically been viewed as an ancillary line item on a given operator's P&L. What I mean by that is if somebody owns an office building or a hospital or a hotel, they might have parking income. They might generate parking income from the parking lot that they own across the street or the parking garage that they have that's juxtaposed to that office building. But their main business is something other than operating a parking lot. And when we go in and we're viewing it exclusively as a business in and of itself, it changes the game. It changes the dynamic. And when you do that, it becomes unbelievably compelling. I'll use an example about talking about recession-resistant assets. If you go back to 2008, 2009, you can look at the Chicago Tribune. The Chicago Tribune, I'm originally from Chicago, so this resonates with me. That company obviously sells papers. If you ask them what their core competency would be, they would say, hey, we generate papers for the country, but largely Chicago. However, during the midst of the Great Recession, the income that they were generating from their core competency, going out and selling papers, dwindled precipitously. And the value of their entire business, the Chicago Tribune, was less than the value of the parking lot that they owned across the street. In the midst of the Great Recession, look, people kept parking, and they're going to continue to park during this recession and the following one. So it just speaks to the pricing power in the space and how phenomenal the asset class truly can be over the long term. I'll let it go, or else we'll just keep going for hours and hours, Kev. I mean,
yeah, right. So for those that are listening, Brian, that want to learn more, obviously we shared some details on the ebook. We can, drop that again. And guys, that will also be in the show notes as well. But, assuming they want to learn more about this space, they're going to grab the ebook. What other places can they go to dig and educate themselves on parking lot investments in the industry as a whole? What would you recommend?
Love this. Two different spaces. I would say one, go to the National Parking Association. There you can get an overview of the asset class, as well as learn a little bit more about how the public and private partnerships interact, along with a litany of different contacts, operators, et cetera. So head to National Parking Association. But I would also say this is very, very important. Go check out the foremost economist on the space. He's a gentleman by the name of Donald Shoup. And he's got a website called Shoup Dog, which is kind of a play on Snoop Dogg. It's actually kind of funny. He's a professor at the University of California, Los Angeles, UCLA. He's been studying the economics of parking for 50 years. He put out a book in 2004, roughly, called The High Cost of Free Parking, which basically took data that he had acquired over 30 years, in which he explains how free parking throughout the country largely has created havoc. And ultimately, we need to continue to reform parking such that we restrict the amount of new parking coming online. So it's one of the additional data points associated with the fact that we believe parking will continue to decline over time. He also created an updated version called Parking in the City. I think that came out in 2018. But if you really want to dig into the economics of parking, go check him out and all of his works. He's very, very well known in the industry. So that's my thoughts. Anything else, Kev?
No, man, I think that's it. And just a reminder, guys, grab that free copy of the book. It's called Parking Lot Profits, the top 10 reasons parking investments generate cash flow and legacy wealth. And just text the word parking lot, no spaces. Remember, all one word, parking lot, to 31996. And again, we're going to also put a link to download the book in the show notes. And Brian, that's all I have, bud. I don't have anything else, man. Appreciate you coming on here. And so if you have any questions whatsoever, we'd love to answer them for you and help you out where we can. So you can simply reach out to us by going to sunrisecapitalinvestors.com, go to the contact us page, drop us a line there, and give us 24 hours. So we'll be back in touch with you. And Brian, appreciate you coming on. And guys, I appreciate you tuning in for this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.